Good morning, everyone, or good afternoon if you're joining us from Asia. My name's Tom Mulqueen, and I'm the Head of Research at AMT, and I'm going to be host and moderating the event today. Over the next 45 minutes, we've got our expert panel of analysts who will be discussing the key themes and outlook for base metals in 2022. But before I introduce the panel, what I'm going to do is take 2 or 3 minutes just to provide a quick recap of what we've seen in the base metals markets throughout 2021 and the conditions that we find base metal markets coming into in the new year. So if we first take a look at the outright prices, we can see that it's been another extraordinary year for base metals in 2021. You saw all the metals had a double-digit performance last year, and tin obviously leading the pack far and beyond with a 90% gain. In terms of the drivers of that rally, I'm not going to go into them in too much detail because it's going to be obviously the subject of the discussion, panel discussion that we'll have shortly. But I think in the main, really, we saw a continuation of this reflation-led rally. So this idea of that we have very strong fiscal and monetary stimulus, and that also the easing of lockdowns causing quite good strength of demand, while at the same time we saw a host of supply issues, whether that was bad weather, the energy crisis, or shipping disruption. So there's been a lot of key themes there. If we take now look at inventories, we can see it's been the other really key theme in the base metal space, that you've seen visible inventories across most of the metals have either been in decline or significantly depleted. So if you look at aluminium, nickel, copper, lead there on the chart, you can see they've all kind of seen this trend of decline over the last few months, or a bit over a bit of a long period for aluminium and nickel. Copper, tin, and lead are all seeing inventory levels that are below 2 days worth of global consumption on the LME, that is. And then you also have this theme of regional shortages of inventory as well. So, for example, in the instance of zinc, lead, tin, aluminium, European inventory is also very subdued as well. So that's been a key theme. So in summary, we have not enough metal or declining inventory of metal in the wrong places and not enough of it available. And that's really a key theme as we start 2022. As a consequence of that inventory situation, we've seen quite extreme moves in backwardation. So you can see on nearby spreads on the LME, all the base metals are currently in backwardation on cash to 3 months. And over the last year, you've seen significant spikes in backwardations, record backwardations, and also significant volatility in spreads as a result of that extreme kind of inventory situation. Also, as a result of the fact that we have had such a strong bull market run in the base metal space, that's incentivized producers to hedge forward, perhaps disincentivized consumers to do so. So you've also seen this pattern of increasing backwardations on the forward spreads as well. That's another key theme. A lot of this tightness in the base metal space has been concentrated ex-China, although you can see if you look at the Shanghai Futures Exchange market, nickel and tin, there is an inventory issue there as well with nickel and tin, and in terms of the backwardations we see on the Shanghai Futures Exchange. So perhaps a more broad spread multi-market issue in terms of market tightness for those two metals. So we have had an extraordinary year. And that's been a result of many extraordinary themes. And I think now is really a good time to take us over to our panel session, and where we're going to discuss whether these themes and these extraordinary themes are likely to persist in 2022, and whether indeed we'll see a continuation of that extreme market movement in terms of prices as we saw last year too. So now I'd like to introduce you to our panel session. So we've got a great selection of panelists today. First, I'd like to introduce Boris and Mikanikrezai, who is the commodity research analyst at Fastmarkets, based in London. So Fastmarkets is a leading provider, commodity price reporting, news and market analysis. And Boris is responsible for researching supply and demand trends across the commodity space, with a particular focus on the base metals. Secondly, we've got Colin Hamilton, who's the managing director and commodities analyst for BMO Capital Markets. So based in London, he leads BMO's market intelligence and price forecasting efforts across base metals, bulk commodities, precious metals, and battery raw materials. So Colin previously headed up Macquarie's commodities research team. He's got over 20 years experience in the metals and mining industry. And then last but not least, we have Eoin Dinsmore, who's research manager at CRU. So CRU offers business intelligence on global metals, mining and fertilizer industries through market analysis, price assessments, consultancy and events. And Eoin is the head of base metals demand and markets team and has been with CRU since 2011. So welcome to all of our panel. Well, I'll start really by just asking some questions on the broad market drivers. What I would say to our audience is if you do have any questions over the course of this discussion, pop them in the chat function on the right of your screen, and we'll try and take some of those questions towards the end of the session, put those to our panel. But really, firstly, starting off with some broad market drivers. Before we dip into the metal supply and demand drivers, what is your big picture take on the base metals markets moving into 2022? Does this reflation rally have further to run, or is the wind changing for base metals prices? And to begin with, I'll put that question to Colin. I think you're muted at the moment, Colin, but yeah.
Oh, not anymore, Tom. Yes, good morning, everyone. Good afternoon. It's an interesting one. I'm a great believer that demand drives the bigger cycles. And what we had last year, as you mentioned, was this huge competition for units. You had strong China, you had the developed world, which was the big surprise, and you had lots of people competing. Now, for me, it's now about a case of, well, how does your marginal buyer feel? There's still supply risk out there. There's still, if you want, a risk premium over where you might think through cycle norms may be. But it feels like some of that intensity of demand is just starting to fade. We've had a really strong cycle. But as we head into monetary tightening in a lot of key economies, with the exception being China, which I'm sure we'll talk about during the event, but with that, it feels like buyers are now just a little bit less nervous. Some of the supply constraints that we were talking about last year are waning. And as a result, I do see a situation where these are very good prices at the moment. And I think that is, something to be absolutely clear on. It's more a case of sustaining those prices. And I do think as we head forwards, I would expect us to be a little bit lower in many of the base metal prices as we head into the second half of the year.
Okay, Eoin, is that something you would agree with as well, or do you have a slightly different perspective on where we are?
I think a lot of what Colin says, I very much agree with. I think a couple of things I'd pick out as being things which will be really important in 2022. And Colin talked about the turn in China, and probably as we look to 2022, it's the fact that we have a big shift in policy support coming in China. We've seen activity there bottom from around August, September time, and it's starting to trickle through now into better industrial production data. So quite optimistic really on what's happening in China. And last year you heard many people saying, oh, we can forget about China because it's the developed world that matters. Well, no, it's still China that matters. It's still the majority of commodities consumption. So I think that's really important. And the other thing is, as you flagged, its inventories are low and premiums are rising. So there's some really strong signals coming from particular markets that are saying we're really tight here. And I would say, while some of those concerns are easing on the buyer's side, if you're buying zinc in Europe today, the concerns aren't gone. There's still some real concerns out there. But ultimately, growth is slowing. But we've got tight markets and China's turning the corner. So that makes me pretty optimistic for 2022.
Okay, that's great. And Boris, have you got a different view or a different perspective?
Yes, no, more broadly the same. But to explain my view, I'd like to share just a chart with you guys. So in my view, 2020 was a deflationary shock because the global economy shut down. And in 2021, it was the great reopening. So the trade to be long commodities, long base metals was quite easy. If you see, like in the chart that I show, it's the base metals index divided by the 6 months moving average on the left axis, and the right axis is global industrial production growth. And so you can see that there is a strong relationship between the two. And if I zoom out from 2029, we had a peak in April 2021, plus 18% year on year in global IP, and a slowdown that was followed with the base metals as well. So that's what we've seen so far. And in 2022, we're probably going to see a deceleration in global industrial production growth. If you see here, last year it was plus 6.9%. and this year it's gonna be plus 4.3%. So if this relationship between base metals and global industrial production holds, that could create some potential weakness for base metals prices this year. But the nuance to this view is that the deceleration in global industrial production growth will translate into softer refined demand growth for base metals. But at the same time, our view is that we're still going to see deficit for base metals. So what we see instead is more a period of volatility. And we cannot exclude like a multi-month correction for all the base metals because of this deceleration in global industrial production growth, because of this toxic macro environment where the Fed is tightening. But to us, it's a buying opportunity for 2022 if there is any weakness.
Okay, great. I think that's a good point on industrial growth, and I think we'll pick up on that in the next section of questions. But I think something you picked up again on there with Boris is this risk, I suppose, from tighter fiscal and monetary policy globally. And I guess there's some differences between perhaps what the Fed is doing and perhaps what we've seen in China in the last couple of weeks as well. But what is your kind of view? Do you think that concern about this fiscal tightening is perhaps overblown, it's premature, or do you think it's been reflected accurately in the pricing that we're seeing in base metals, or do you think how big of a risk do you see it as being this year to the base metals? That's to Boris again. Yeah, sorry.
Yeah. So when you look at the past, the previous tightening cycle from the Fed, what you see is not necessarily like a decline in risk-taking appetite. For example, when you look at equities, it's more a period of trading sideways. And so in 2013, 2014, with the tapering, you've seen that in the equities. But the weakness in the base metals back then came from China. And so to me, the dollar index has increased substantially over the past year because of this divergence between the Fed's policy and the rest of the world. But I think that now it's mostly discounted by the market, because when you look at EMs, emerging market economies, they tighten over the last year. And so to avoid inflation issues, and so now you could argue that the long dollar trade is down, and when you look at the positioning in the dollar, it's quite stretched. So even if there is still a divergence between within the developed market economies, for example, the Fed versus the ECB, who is not thinking about raising rates, you also have to look at the Fed versus EMs. And so we could see not necessarily like a continuation of the dollar rally, but instead a stable dollar. And I think what will matters most for base metals is what happens in China. And we could argue that China has already entered an easing cycle. And the chart that I like to share is, in my view, like a very important chart is the Chinese credit impulse. So the Chinese credit impulse, the way it can be defined is the 12-month sum. It's the 12-month change in the 12-month sum of total social financing. There is a bug. Do you see the chart?
Yeah, we can see the main part of the chart, the part that's relevant. Yeah.
Okay. Yeah, and it's measured in terms of percentage of GDP. And what you can see is that last year there was a big decline in this credit impulse from China, and it turns negative. But if you zoom out and you see that there was a turn in October, moved from -5% and now it's -4%. And what happens is that if China eases its monetary policy, we could see a rebound in this credit impulse. and so it could reduce the divergence. But now, if there is a big divergence between base metals and the credit impulse, and we could justify it with the fact that base metals have strong fundamentals. So it's not purely about the Chinese credit impulse, but it could have an impact next year. So I think that the gap will close down in 2022.
Okay, that's great. And Eoin, do you have a view on the fiscal monetary impact, or what that's going to be, net negative or positive? Do you subscribe to what Boris is saying, or you're a bit more optimistic, a bit more negative?
I think slightly cautiously optimistic. There's no doubt that in the US, fiscal policy moves from being a very strong tailwind to definitely less of a tailwind. I wouldn't go as far as say it's a headwind, but you've got very strong consumer balance sheets. You still have the infrastructure plan, which will be spread out over a few years. That's going to be commodity intensive. You look at the EU, again, you're getting commodity intensive investment coming through there as part of the Green Deal. So I think there's no doubt it's not as strong on the fiscal side, but it's not a matter of we're hitting a major concern and it becomes a big headwind.
Okay, sure. And do you have a view on that, Colin?
I've tendency to agree. I mean, I think, and we'll talk about the China situation. I think there's no doubt China credit availability is picking up. I think the question for metals is when the actual demand for credit comes through, because that's where the weakness is at present time. There's not the confidence in that Chinese economy yet, despite the fact that growth rhetoric is clearly being pushed pretty hard from a central government point of view.
Okay, sure. I think we'll dive actually straight into the demands. A couple of questions on demand, actually. So I think we talked about how the stimulus-fueled economic expansion has kind of underpinned metals demand growth in 2021. Do you think that will be maintained in 2022? And I guess we talked about that a little bit already, and Boris has touched upon that. But are there barriers to this kind of continued synchronized recovery between the US, Europe, and China that we saw? So what I guess are some of the more individual drivers that you're concerned about in China, perhaps, for example? And maybe Colin, you'd like to answer that.
Sure. So, I mean, of course, China didn't contribute much to metals demand growth actually over the course of last year. It did in certain commodities, but I mean, you look at some of the early ones like steel, negative, copper, flat. Now, we know China's trying to simulate. What is interesting is that the mechanism's a little bit broken at the moment. In the old days, it was you tell local governments what to do, and they go and do it, and they get projects going, and that gets you a big fiscal impulse coming. Challenge at the moment is the local governments, of course, have sold no land for the past 6 months. So they have no revenues, they have a lot of debts to service in the local government finance vehicles, and as a result, they're not reacting to the central government push in the same way. Now, that means we will probably get a second round of stimulus in China, which is much more aggressive, I think, over the next 2 to 3 months, and that will start to boost things, but there is obviously a lag here. And I think what's interesting to me, actually, I mean, in all my years doing this, I've never seen such a wide range of views on China. Generally, it's like, well, we think China's going to be a little bit better or a little bit worse. I have clients talking to me now saying, well, China could be down 30% for copper demand, which is extreme, or China's stimulating and inventories are low, copper prices going to the moon. So you have both of these views there. I do think that as we think on the demand side, China still does drive the near-term delta. What I'll be watching very, very closely is the pace of inventory build over Chinese New Year. We're getting to that point in the year where we do expect inventories to build, but how aggressively are they building? And are we seeing material pulled down the chain, or are downstream consumers saying, well, and you asked about one of the big headwinds. One of the biggest headwinds is actually metals prices themselves. I mean, this is what inflation does. We have high prices, and that does dissuade your marginal buyer to a certain extent. So what I'll be looking for is any evidence of that coming through. I think the situation is, as we talked about before, in other places like Europe is a little bit different, given some of the pressures there, and I'm sure Eoin will talk to those. But for me, in terms of China, we'll be looking again, it feels like every year, but in that kind of 3 to 6 weeks past Chinese New Year, how aggressive is demand starting to come through? And that will give us a good guide for the rest of the year. Okay,
great. And briefly, Eoin, do you have a slightly different perspective, CEO, a different perspective on China growth for next year than Colin?
No, it's interesting. So if I was left alone and I wasn't allowed to talk to our Chinese analysts, I'd be very bullish. I'd say, look, they're sorting out the real estate side. The state-owned enterprises are coming in. They're buying up the bad projects. The government wants this to grow. It's going to be, I think you're moving into a world where you've got like a really much slower growing, much more controlled real estate sector, but you're going to have, rental properties being built, and you've got some real support to that. So I can look at it, and if I sit here in a bubble, I'm bullish. Then I talk to our analysts on the ground in China, and they're not. And then you start to ask yourself, why, what's happening here? And as Colin says, the government wants to lend money, but the enterprises aren't particularly confident about it. So if we look at things like it's a lot of the price comments are coming up. So particularly on the copper side, when you're talking to the tube producers, they really are holding back as much as they can because of where prices are. But ultimately, they do have good order books. So I think that there's a big hesitance and a big hesitancy about how this year is going to pan out from our analysts on the ground in Beijing and Shanghai. But order books are quite good. Export demand is still running very strong. The big risk is how disruptive Omicron is to supply chains in China in the next 6 months, and it's not looking great. There's definitely some reasons to be concerned on that front. But overall, I'm pretty optimistic on China. It has to be tempered with what we hear on the ground, which is far more hesitancy, concern still about the construction market that's coming through from steel, zinc, and the alley analysts in China as well. So there's definitely reasons to be concerned, even though the government is making all the right noises.
Okay, that's great. And I think you made a really good point there, Eoin, about the strength of Chinese demand. I guess they are increasingly reliant on the exports to maintain that demand, that strong demand we've seen in China, and perhaps domestically it's been a bit weaker. I guess one of the things that's fueled that, I suppose, has been that trend over the pandemic of spending on goods rather than perhaps services, that perhaps the spending preferences has shifted perhaps more towards goods because it's been forced to, because services spending had been restricted by lockdowns and such and such. And Boris, do you think that situation is something that we're likely to see normalised? Do you think that we might see spending perhaps migrating a bit more towards services and away from goods? And do you think that could have an impact demand on going into 2022?
Yes, it's likely, because when you look at the latest development surrounding Omicron, it seems that the end could be near, and therefore you could see a shift from physical demand to services, and then it depends on the policy reaction. So, for example, in China, if they stick with their zero COVID policy, like the shift is unlikely to happen. But China is, I think, wants to support its economy, and so at some point they might have to change this policy, and so we could see indeed this shift, from physical goods to services, and that would be slightly negative for the base metals, but it doesn't mean that physical demand will suddenly fall substantially. So it's just slightly negative, but not very bearish.
Okay, sure.
I mean, it's interesting, Tom, because metals are a work-at-home trade. They happen to work-at-home trade. I mean, you think of it. I was sitting at home yesterday going, "Oh, I need a new kettle." Now, I probably wouldn't have done that if I hadn't been sitting at home. So, and it's interesting. I mean, I think one of what drove metals demand last year, early part of the year, was the lag effect of Chinese fixed asset investment, but then it was good old-fashioned developed world consumer durables. Now, obviously, I think the question many of us are asking is how much of that demand's been pulled forward. I mean, and therefore, do we have a little bit of a weak spot over the coming years? It's not yet. And obviously, if we get renewed restrictions and we have people working at home again, you probably get another surge in terms of that durable goods ordering. But it comes to a point where you go, well, actually, I've done everything I need to. And obviously, real wages are going to be very important in terms of that, which brings us back to the whole inflation debate.
Yeah, I guess it's an interesting question. We talk about perhaps normalising from the pandemic, that you have some drag factors like that. But I suppose that you have ongoing restrictions. It makes issues like shipping chaos it prolongs issues like that. And I know we've seen the slowdown in the automotive sector and the issues they've had with chip shortages there. And I guess there's from ongoing pandemic restrictions, I guess there's some negative demand headwinds there as well. So I guess it's quite hard to work out sometimes with easing of restrictions. Is that always a net positive, or it's not always so clear that it's 100% positive for metals?
Yeah, and so I think what we've seen in terms of it, the first thing that gets hit in terms of any shutdown is logistics. So actually, it's inflationary in the short term, because your marginal buyer is like, well, hold on, my container's not arrived, so therefore I need to be a bit more aggressive in the market. So and obviously we are seeing the Chinese port issues come back, which had been easing in the second part of last year. You mentioned the chip shortages, Tom. Obviously, I would actually say the auto data has been improving quite significantly in Asia over the past little while. But if we are to see, and it does come down to, I mean, how aggressive is China going to be with these lockdowns? If we do see some further lockdowns again, well, therefore, we start to see more restrictions coming through that chain again. I mean, there's a lot of cross currents there, but actually, lockdowns tend to be inflationary in terms of metal prices, certainly in the short term.
Sure, yeah. Moving on briefly, just to talk about the, I guess the longer term outlook for metals and how that's feeding into prices a little bit. So, I mean, there's been a huge talk about green technology, the green transition. Eoin mentioned the Green Deal in Europe a bit earlier on. Do you think that we are in the early stages of a golden decade for metals, buoyed by this kind of green fervour about green investment? Do you think that the market is currently pricing the potential from metals demand from these new applications and new investments correctly? Eoin, perhaps you'd like to have a stab at that one.
Yeah, I'm gonna make the least popular comment when it comes to green revolution, which is, and it's good. We're already talking about China slowing, but I just want to just get kind of make it up front. We can't have that conversation in isolation. We can't talk about green revolution, strength in demand from renewables and EVs, and we don't say huge Chinese construction sector was the engine of growth. It's going to be shrinking in the next 5 to 10 years. So it's just kind of like, let's just get that in there first, because it's really important before people get overexcited about the demand growth that's going to come. But ultimately, it is incredibly important. We have 70% of copper demand between now and 2026 is coming from renewables, grid investments, and EVs. So it's exceptionally important. I think there's one thing I will say when people look at outlooks for metals usage or intensity, is the technologies are moving so fast. If you're looking at a first generation EV versus what they're being made today, and you're running your model off that Gen 1 EV, you're totally wrong, because they've really found ways to save money. They've redesigned. We talk to companies, tier 1 automotive producers, and they've said that's the best solution you can ever make, but we can make it much cheaper and it's good enough. And that's what's going into the next generation of vehicles. So I think there just needs to be a couple of people just need to say, yes, look, this is incredibly important. It is changing where the demand growth is coming from. Ex-China is incredibly important. But at the same time, China wants to kind of hold that leadership in green tech, which means that, you're going to, when China goes to stimulate now, it's going to say green tech's going to get it. So wind and solar really gets a boost. So there's many positives. I just want to get that caveat in there that it's not happening in isolation. Sure.
And Boris, do you think that it's something that people are perhaps a bit too optimistic about, or not optimistic enough?
No, I'm very optimistic about it. I think that this green transition is a proper catalyst for a very long cycle, like a super cycle, if you will. That you have all major economies, implemented these policies that are, very important for base metals consumption, especially copper and nickel. And you have already a lot of market participants trying to secure those metals. So it's to me, where we're in the cycle is very early, because you had in 2020 this deflationary shock. You have a rebound, and then the question is, will this rebound be transitory, or will it be sustained? And so I feel that we're in this period of confusion. When you look at investor sentiment, it's neutral to bearish when you look at the positioning. In part, it has been impacted by the Chinese tightening. If you look, for example, at the net long positioning in copper versus Chinese equities, there is a strong relationship there. And so you have a rather fragile sentiment within the commodity space. You have mining companies being reluctant to invest more. So themselves, they are not very confident. And if I can share with you like a chart that I've made, it's basically it's the deviation from a 20-year trend, right? So here we can see that even if there was a big price increase, from 2020, when you look at all the base metals and a deviation from the trend, we're not near any excess. For copper, it's like roughly around their 20-year trend. Aluminium, same. Nickel, same. Zinc, same. Lead, same. And tin, same. Even tin, that doubled last year, we're still like near at 0% from their 20-year trend. So to me, there is much more legs coming on in the longer term. But again, as I said before, it doesn't mean that we couldn't see, a possible multi-month consolidation in 2022, depending on the macro environment.
Okay, that's great. I will move. I'm really conscious of time. We've only got 10 minutes left, so I'm going to move on to the few questions on supply. So energy availability was a massive constraint on metals supply in the latter half of 2021. So initially, I suppose we had the issues in China, and now we've seen now the focus moving more towards Europe and the issues with high energy prices there. Do you think that this ongoing energy crunch is something that's going to be a temporary seasonal issue and it's going to ease? Or do you think this is the beginning of something more permanent or repetitive in the metal space? It's something that we're going to have to be a lot more worried about now over the next few years. And Colin, perhaps you'd like to answer that.
Oh yeah, okay. It's an interesting point. I mean, there a couple of things. I mean, number one, demand for energy was very strong, and is that cycle? Is that the fact that we have people working in two locations and we're heating double the space and we're using a lot more data? Well, actually, yeah. So I think the trend in terms of energy demand is going up, and that's putting more pressure on the chain. Now, then of course we come back to the raw material side, and it's not just metals and mining markets where the companies aren't investing because they're being told, well, we don't want to see you invest in terms of growth. Oil industry as well, coal industry we know about, and even to a certain extent the gas side. So with that could lead to, some ongoing pressures. There will be an element of seasonality to it. And I think that's what we're starting to find out a little bit more. When we get into Northern Hemisphere winter, we are going to face a few more of those pressures. Will China let that situation happen again? Less likely. I do think you'll see more active policy there in terms of the coal side, just to make sure. And I can easily see a coal reserve being built. China has a lot of stranded coal up the northwest that I think we might see mined and used as a strategic reserve to try and alleviate some of that potential constraints. Because if there's one thing the Chinese government doesn't like, it is those type of inflationary bottlenecks. But it does feel like we are going to be factoring in higher energy pricing into our medium-term expectations. I think that's the way I would phrase it.
Okay, great. And Eoin, do you have a view on that? I know CRU do a lot of work on costs. How big has the impact been? Do you see that having a lasting impact this year?
Yeah, it has a hugely lasting impact, and I think I've flagged two points around it. One is for the energy-intensive industry, so particularly aluminium and zinc smelting. We're moving to grids with more renewables. Grids with more renewables mean your energy, supply into the grid is more variable. You're an aluminium smelter and you say, hey, I want a huge base load of power all the time. The power company is saying, well, my base load's very valuable to me today because I need that to moderate when I've got dips in the renewable generation. So longer term, there's a huge challenge for the energy intensive industries, and I've particularly flag aluminium and zinc on that. So I think that is there to stay, and it's a huge risk. The second one that's important to flag is the dual high policies in China. around energy intensity and emissions. And the thing that we would point out is what's happened on a provincial basis versus what's happening on a national basis. So the provinces have gone out and approved lots of projects, and this is kind of back to the past really here. And when they've done those, they've thought it's okay. What I have approved is basically in line with the government targets on energy intensity and emissions. It's not. The provinces have gone further than they should have done, and I think you've seen that come up in different government bodies in China on their inspection saying that project shouldn't have been approved, that project shouldn't have been approved. So I think variability from renewables and what's going to happen are all of the plants that are expected to come online from copper smelters, alloy smelters through 2022. Have they really got central government nod, or did the provincial government take a bit of an overstep?
Okay, yeah, some very valid points there. Boris, I wanted to ask you a question going on to a separate issue. Do you think that the higher prices that we have seen in the base metal space are likely to trigger a fresh wave of mine investment, a fresh investment cycle? Or do you think there's some restrictions there? Are higher prices going to be the cure for higher prices, as the adage goes? Or should market participants be concerned about insufficient investment and mine supply growth over the next medium term?
I think eventually it will trigger new supply, but just for now there is this reluctance, and with this ESG, it makes it even more complicated to invest in those projects. So probably we're gonna need higher prices and a change in the mentality, and it might take a little bit of time, maybe 1 year or 2 years before we see a change. But for now, the supply is probably going to lag, and so we are in a configuration where the market is tight. As you show in your slide, we're in backwardation for all the base metals. Demand is higher than supply, and so it will push prices higher until it trigger a supply response.
Okay, great.
Tom, if I can just add briefly on that. I mean, if I'm sitting on the board of a mining company at the moment, it's much harder to approve a project than it was in the past. Number one, shareholders they've said, look, we want money back. You've invested money. We don't want growth from you. We want returns. So therefore, you're here to pay us a dividend. We've just seen Rio Tinto come out with a 12% annualized dividend overnight. This is the sort of thing that shareholders are starting to get. Now, then you have other pressures. I mean, when companies are making money, not only do shareholders want more, so do communities, so do workers, so do governments. You look at the situation in Latin America. If I'm sitting on the board of a company, I want to know what the royalty rate in Chile is going to be. I want to know what stake President Castillo might want in my mine in Peru. It makes it a lot harder, and then you overlay the environmental side as well. So I actually think that, I mean, there's a number of secular reasons now where it's harder to see the natural response. Now, this is interesting because we've had a period of high margins here without the supply response. It does mean, as Boris said, look 2 or 3 years down the line, we're still pulling supply from the models. We're still saying, actually, this supply is going to disappoint relative to expectations, which does mean that, I mean, suddenly that medium term, particularly with the annuity demand from things like the energy transition, starts to look tighter.
Sure. I guess it's an interesting point you're making about these different pressures that are coming in. I guess it's the idea of quality over quantity that I've heard a few times. That phrase seems to be bandied around quite a lot at the moment. And I guess with the decarbonisation theme, that kind of ties into it. I guess these mining companies have got other things to worry about, I suppose, than just how much metal can they get out of the ground.
No, it's absolutely right. You're seeing a lot more sustaining capital spent, which includes a lot of decarbonisation. It's interesting to see a lot of the tie-ups you're seeing between the mining companies themselves and some of the suppliers, whether it be electric locomotives, whether it be some of the equipment suppliers, to work on the decarbonisation. That's where shareholders want that incremental capex dollar spent rather than new growth projects.
The only one thing I'd pitch in is, if we look over the past few weeks, we've seen Rio announce investments in Argentina, BHP come with Tanzania. So they've been saying for a while, we'll start to look other places. So there is a little bit of that, but they have been really focusing on, can you buy the growth? Can you buy an existing plant? And then you're not adding anything, but you're delivering an asset that's up and running. The risks are lower. But I think, they are starting to find a little bit more comfortable to go to places they really hesitated to go in the past.
Okay, and I think that as a kind of to round this up, I realise we're getting towards the end of the allotted time. Is for each of you, I'd like to ask, what's your top metal pick and your, I guess, least favoured metal pick for the year, and perhaps some of the reasoning behind that. I don't know if Eoin's dipping his head, whether he's worried that I've asked him that question. But perhaps we'd like to start with Colin. Do you have a most favoured or a least favoured?
Okay, interesting. It's I mean, if we've been having this discussion maybe at the start of the year, I said nickel might be the least favoured, having because I did think there was a lot of stocking of Chinese MPI ahead of a potential Indonesian ban, which has not come to pass. But then you run the numbers and you look at it and you go, well, actually, we had a 180,000 ton deficit in that market last year, 6% of market size. We need a lot from supply to actually perform. So, I mean, I suppose as I mentioned at the start, I'm relatively cautious on the demand side overall, and we're coming from very high price levels. So therefore, I'm saying, well, what can hold up best? And I do think nickel can actually hold up better than many people think over the rest of the year. Battery demand still very good. I mean, obviously, if we are looking at a cycle that it is turning down and we do get a bit of disappointment in terms of Chinese demand coming through, what's more exposed? You would say, I mean, copper and zinc trade at a good premium. I'll be looking carefully at zinc in terms of, I mean, have we actually seen the cuts that have been perhaps announced? If we haven't, zinc looks vulnerable from here. I do, to be fair, have the copper price lower as we head into the second half, which is just a function. I mean, it's a roughly balanced market, but just less demand aggression coming through. Still at a very good price for producers, still at a good price for the industry and a good price historically, but definitely one that's slightly lower than we are today.
Okay, that's great. And Eoin, do you have a pick? Or
Yes.
I guess you've got your specialist ones that you follow anyway, but are there any that are standing out?
Yeah, I think it's, we probably, if we look at it in 3-month and 12-month view, zinc and aluminium for the next 3 months are definitely, the ones with the most upside, probably more aluminium than zinc, because you have seen far more curtailments really happening. On the aluminium side, inventories are falling in China. We've had some pretty impressive exports there as well. But I think on a 3-month view, it's aluminium. On the 12-month view, actually copper, because we think, the market is tight for this year. We see that improvement in China. The negative sentiment really has been emanating out of China. So as we start to get better data coming through there, the market is still tight. We'll start to flush out what's in supply chains in the next few months, and we're pretty optimistic for copper prices for the second half of the year.
Okay, great. And Boris, you agreed with Eoin or Colin, or do you have a different metal that you're looking at?
So yeah, my view is slightly different. I would say if you try to see the biggest divergence between prices and the fundamentals, I would pick nickel or copper. And for example, tin, I like the fundamentals. I think they are really robust, but prices are very strong. And to see the divergence between prices and fundamentals, I did a little study that I'd like to share. It's basically I'm purging commodity prices from the dollar effects. So basically, I run a regression of commodity prices against the dollar, and I use the residuals and I destandardize them to try to see if the dollar impacts were removed, what would be the commodity price, the adjusted commodity price. And so that's for all the metals. And the results of this is the biggest difference is with nickel. So it would trade nearly 50% higher, and copper 44% higher. And you can see, for example, tin only 20% higher, because tin usually is micro driven, so it is not really impacted by the dollar. So that's why the prices are the fundamentals and the prices do not diverge, but there is a divergence to us with nickel and probably copper. And also, when you look at global macro investors, for now they are not playing this reflation trade. They are staying cautious. But if you're a macro investor and you want to get exposure to commodities, you will probably prefer copper, nickel, and maybe aluminium. due to the exposure to the green transition. So that's why I would choose nickel or copper over the rest of the complex.
Okay, that's brilliant. I think we've got towards the end of the time of our session today. And what I'd say is, if there's anyone in the audience who's got any individual questions for our panelists, when the session ends in a moment or so, you'll be able to ask them directly during the networking session that we'll be having directly after this panel. So just join one of the tables or set up your own, and feel free to ask some individual questions. What I'd say is, if you enjoyed this event that we've put on today, I'd encourage you to follow AMT on LinkedIn to get notified of future events. There's a QR code above you at the top of the screen. And I'd also encourage you to do the same for Fastmarkets and BMO and CRU, because I know you're all putting out quite regular public content out there on the metals markets, which is always a good read. So I'd encourage you to do that as well. And that only leaves me really to say a massive thank you to Colin, Eoin and Boris for giving up the time to participate today. And thanks for the audience for listening in and waiting through those technical issues that we had right at the beginning. So I hope to see you all in the networking session in just a couple of seconds. Thanks, everyone.
Thank you very much.